Hey guys, Dave Keller here with Market Misbehavior. Why is sector rotation so important, and particularly from the technology sector? We'll talk about why the XLK, the technology sector, is the most important chart where we need to see some improvement. So in any sort of normal bull or bear cycle in equities, you have what's called sector rotation. Certain sectors will tend to lead in certain environments and will tend to lag in other environments. Sam Stovall, who's at CFRA Research, wrote a book a number of years ago, which really formalized a lot of the assumptions many investors have made for years about strength and weakness of different sectors at different times. If and when the market actually finds a bottom after a bear market cycle, certain sectors tend to lead coming out of those market bottoms, and it's two sectors in particular, technology and consumer discretionary. So in today's video, we'll look at a chart of the XLK, one of the key technology stocks where we need to see an improvement, and why it's so important to pay attention to the FAANG stocks in this sort of environment in particular. Before we get to the charts, if you like this sort of thinking about market history, market dynamics, technical analysis, behavioral finance, all those things, if that's of interest to you, I hope you'll subscribe to my channel. Also give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below the video if you could. Do you agree with my assessment of the technology sector? Yes or no, and why? Let's get to the charts. All right, we're going to start with Sam Stovall's sector rotation model. He wrote a book a number of years ago focusing on sort of the tendencies of different sectors in different parts of the market cycle. This idealized diagram of the market cycle in orange and the economic cycle in blue sort of gives you a framework. Now, it's worth noting, by the way, a lot of people look at economic data like inflation, like unemployment, like jobless claims, and use that to make assumptions about the stock market. What you have to remember is if you're doing that, you're actually flipping it. One of the best predictors of economic health, strength, and weakness is the stock market. One of the leading indicators for the economy is the stock market. So if you're looking at economic data and then trying to use that to predict stocks, you're actually flipping it the wrong way. You should be using the stock market to predict the changes in the economy. This is why the market will tend to turn before the economic data starts to get really bad. The markets will also start to improve before the economic data does. So if you're looking for improvements in economic data during a bear market phase, you're better served just looking at the price of the S&P 500. That's going to be a much better indication of a recovery. So now that we've confirmed the fact that the markets tend to lead the economic data, let's look at what actually happens. Here's the market sort of bottoming in orange in an idealized cycle. You're going to have the bull market phase, a market top, and then the bear market phase. In a bear market phase, you tend to get leadership from fairly defensive sectors like consumer staples, healthcare, utilities, all of which we've certainly seen in 2022. Real estate and financials tend to be leadership toward the end of the bear market phase during the early beginning of a recessionary period. We really haven't seen leadership, particularly from the financial sector yet. So this is a little bit off the playbook at this point. But when the market would hit a bottom, and this is why I'm bringing this up now, a lot of people are just constantly looking for signals of a bottom. And I've heard during the course of 2022, any bounce, I get people telling me that was the bottom. But here's the problem. For you to really feel good about improving equity market conditions, you would really need to see leadership from technology and consumer discretionary. And that comes from the fact that most major market bottoms have seen leadership from those two particular sectors. Let's look at what's actually happening right now, though, with the technology sector. This is the XLK. I have some Fibonacci lines, some moving averages, some horizontal lines, which I'll mention in a bit. Then at the bottom, the relative strength of the technology sector, the XLK, versus the utility sector, the XLU. You can see this rotation from uptrend in second half of 2020, most of 2021, with the XLK making fairly consistent higher highs. Most months, you saw a new high in the XLK over that year and a half period. The XLK actually peaked out in December, which is interesting because the S&P actually peaked out in January. The NASDAQ peaked in November. A lot of breadth and momentum measurements did in November as well. Technology is a little unique, and it actually peaked at the end of December. It did not make a new high going into January. From there, though, you can see a breakdown of the 50-day moving average, a breakdown of the 200-day moving average, frequent breakdowns of key support levels. And that's the confirmation of a bear market phase. A bull market is a pattern of higher highs and higher lows. A bear market is a pattern of lower highs and lower lows. There are a couple key moments for the technology sector over the last 6 to 8 months, which I wanted to highlight. Number one, the fact that we broke down through the 50-day moving average, retested it from below, and then rotated downwards again. A lot of times you'll get a stock that will, or a sector, an ETF that'll break a moving average only to go right back above it very soon after. One of the key markers of a bearish phase is you have a breakdown of support, you have a retest from below, and then you rotate lower. And that's exactly what happened with the 50-day moving average in early January, mid-January, really. The second thing would be a very telltale sign, which was in late March. We had that initial bounce higher in January, where the XLK, the S&P 500, a lot of things, sort of bounced off of the low in late January, sort of made a lower high in early February. We then made a new low of February and March, and then retested those highs. Charts like Apple and others attempted to make a new swing high. The S&P 500, this is when it was testing 4,600 from below. The S&P actually went briefly for like one day, went above that level, only to rotate right back to the downside soon after. The XLK actually literally almost to the penny tested that same intraday high that we tested twice in early February, was unable to get above there and rotated lower. In a downward phase, charts will be unable to overtake previous swing highs, which makes a pattern of lower highs as the market attempts to rally, but is unable to get above the previous resistance levels. So that failure in late March was a real telltale sign for the XLK, also a telltale sign for the markets as a whole as they continue to push lower. You can see this horizontal blue line, the horizontal orange line identify previous levels of support that held, at least initially, before finally breaking. And I think this last one was most important. The support from February and March, we tested that again in April, bounced off of there for a couple of weeks, broke down. And then once again, we retested a key support level from below. So support becomes resistance, and then we rotated lower once again. So clearly the technology sector, as with much of the equity landscape, has been in a fairly established downtrend. So what about now? Well, we've bounced a bit in the last week. In the last couple of days, we've closed more toward the upper end of the trading range, which is kind of interesting. But here's the problem. To really indicate a rotation out of this downtrend, to really fulfill what Sam Stovall made very clear as the leadership out of a bear market bottom, you would need to see a rotation. You need to see outperformance by the technology sector, and most likely you'd need to see higher lows and higher highs. So if you look, we've made a fairly consistent pattern of lower highs and lower lows, which means the technology sector would get above this level in late May, early June for you to really reverse that pattern. Also, you'd want to see a higher low. So most recently in June, we've undercut the low from May, which is where we also undercut the low from April and March and February, really not, so late February and June. So every month, the XOK has made a new low. We would have to stop that from happening. We'd have to make a higher low, a higher high, which would reverse that trend. We'd have to not just attempt to eclipse a previous resistance level, we'd actually attempt to overtake it. The most important part of this chart, all of that being said, is at the bottom. When you think about this rotation, right, what that chart, Sam Stovall's idealized chart is showing you is the movement from defensive leadership to offensive leadership. People stop buying utilities and real estate and start buying the offense, like consumer discretionary and technology and communication services, which means the XLK would have to start outperforming the XLU. Put another way, technology would have to outperform utilities. One of my favorite sort of bear market charts to follow is the relative strength of utilities. As long as utilities continue to outperform, investors are still fairly defensive, and you want to hold off on any sort of aggressive long ideas until you see an underperformance of utilities. So this relative strength line has been in a clear downtrend since the end of November of 2021. In the last 4 to 6 weeks, we've seen a bit of a bounce higher where technology's actually been outperforming. You need to see more of that. You need to see that relative strength line continue to rotate higher. We've seen bounces previously over the last 6 months. Every one of those has resolved to the downside. Instead of resolving lower, you need to see the improvement there. Based on what I've seen overall, based on the actions of the Fed and the most likely continued headwinds to growth stocks, I would argue that it's most likely we have more bear market environment to digest before we would start to see leadership from technology that would indicate an end to this bear market phase. However, this is one of the charts I'll certainly be following. The last chart I'll mention to you is the chart of Microsoft. The XLK, the XLU, the broad sector ETFs are perfectly fine to follow, but also you want to see leadership from individual names. Microsoft was one of those fantastic charts in 2021, just leading to the upside, outperforming on a relative basis. strong and ever stronger going up and to the right. That all changed November, December, January as we started to rotate lower. Microsoft has been consistently below its 50-day moving average. It's made lower lows every month in 2022 so far. You need to see that change. So what I would be looking for on the Microsoft chart is to stop making lower lows, make a higher low, start making higher highs, eclipse the 50-day moving average, get above 275, which would make a new swing high for the first time really in a number of months. The momentum would have to turn more positive. If you look at when Microsoft has rallied in 2022, the RSI has stalled out in the 50 or 60 range. That's more characteristic of a bear market phase where the rallies don't really generate enough positive momentum. You need to see the RSI from Microsoft get above 50 and even to get above 60 on the next rally. That would indicate sort of an inswell or an influx of buying appetite, which would potentially move Microsoft more to a leadership phase. All of those things would most likely cause the relative strength in Microsoft to improve. That would help me feel much more confident about the leadership that I'm seeing from key technology stocks, which could be indicative of a bear market bottom. So there you go. That's sort of the general idea of sector rotation in a bear market phase, what tends to lead on the way out. We also talked about the technology sector, why the relative performance of technology versus utilities could be an interesting ratio to watch, and what we would need to see on a chart of the XOK to feel better about this environment. Also, key leadership names, FAANG stocks like Microsoft would need to improve. They would need to stop making lower lows, start making higher lows, and also show an improvement in price momentum, which is so important in this sort of environment. That would indicate an influx of buyers, which we have not seen yet in 2022. Again, thanks so much for watching our videos. Please subscribe to our channel. Keep following our work. We thank you so much. We'll talk to you again soon. Bye now.